Let's turn to some more investments that we might be used to. And for that, I'd like to introduce Sean Leonard. He's a partner and wealth advisor with Cerity Partners. Last year, he was with Gray Point Advisors. He can tell you about that. He has expertise in investments, estate and income tax planning, compensation, insurance, charitable giving. He's the former CIO at Gray Point, Rockefeller Capital Management Family Office, and ACO Goldman Sachs. He has a BA in mathematics, an MBA. He is a chartered financial analyst. He was supposed to be here with his partner, Dan Nolan, but Dan is not feeling well. So Sean is going to carry the weight for Cerity Partners. Thank you, Sean.
So thank you. Dan, the first part of what I'm going to go through is something Dan usually talks about, so hopefully I hit the mark. But I think one of the things that came through for me on Rustin's slide, right, is complexity. I mean, the world is changing really fast. Money seems like it is everywhere, right? So I was driving down and I saw the Mega Millions is $840 million, right? And right next to it is the Powerball, I think, that is $430 million. Those are huge numbers, right? Huge numbers. We are minting more billionaires under the age of 30 in the United States than we ever have. Elon Musk is negotiating for a $1 trillion, right? $1 trillion pay package, and you might get it. I mean, it's a lot of money. So I do want to pay homage. We talked about Gray Point, and Gray Point was our firm. We just merged with Cerity. We're super excited, happy to talk to people about that later. One of our founders at Gray Point was Hugh Johnson, and so a lot of people in the area know Hugh Johnson. One of Hugh Johnson's favorite economists was a 19th century economist, Charles Kindleberger, and he had a quote, which Hugh rolled out often, which was that there's nothing as upsetting to one's well-being and judgment as to see a friend get rich. And the idea is that when everyone else is getting rich around you, you look at it and you say, wait, should I be doing this, right? And I'm coming back to that a lot in what I talk about today. But one of the things you'll notice then is to risk or not to risk. That's the question for today. The markets have been up tremendously. We have seen a huge amount of growth in wealth for investors, for individuals, and risk is almost Pavlovian in that financial advisors will tell you it's bad. Risk isn't bad, risk isn't good. Risk is just a function, right? And you have to understand that. Risk can create huge, in green, wealth. It can lead to absolute devastation in losses, right? So is anyone familiar here? Has everyone ever heard the name John Paulson? John Paulson, the hedge fund manager, 2008, made a tremendous amount of money for his clients and for himself by creating and placing a very esoteric trade on mortgage-backed securities. And it was 1,000% plus, maybe a 10,000% plus return, okay? So that was risk done well, created a lot of money. What people fail to realize along the way is anytime you have that level of risk, well, when he put that trade in, it doubled for him. And he said, that's great. I think there's a lot more to go. And then it went up 10x. And he said, I think there's a lot more to go. And it went up 100x. I still think there's some more to go. It went up 1,000x. Okay, this is a lot. And it still held on to it for another 10x return. At any point along the way, that could have gone down in value materially, right? Why that matters, we are seeing a lot of clients and a lot of investors today that have been very fortunate in that they've owned what were small or medium-sized positions in technology, large technology companies that have exploded. And now they're sitting on, and you're seeing it probably in your practices as well, they're sitting on, $5 million, $10 million of wealth tied to individual names that are up 2,000, 5,000%. And on one hand, they're all very happy. On the other hand, some of them are a little bit scared. And on the third hand, if I had a third hand, right, the question is how do you get out of that stock without creating capital gains, and do they want to? And one of the bigger things there for people is that fear of missing out, because they're worried, by the way, it's already up $2 million. It might double again because I've gotten used to seeing it double. So what do I do? So one of the things that we always talk about with clients is obviously, again, Pavlovian, right? Risk mitigation. So first is understand for the client, what are you trying to accomplish? Some clients do want the risk. They're comfortable with the risk. We try to think about how you can mitigate it. And there's different ways. One is stay conservative. Well, those clients are not conservative today. If they were conservative when they started and those names have just exploded, that's a real conversation to have with them, because we're going to talk about, are we in a bubble or not a bubble? And I will tell you with 20/20 clarity in a year from now, right? But the problem with a bubble is you never know during, are you in it? And so for anyone that is really remotely concerned or getting close to retirement, and they're looking at these assets as their future, right? You have to start thinking about how much loss can you take. So one, stay conservative. Many of these investors today aren't, just because the assets have done well. Can you think about ways, tax loss harvesting, et cetera, to try to get them back in line? Maybe. Diversify, right? That's part of the same thing. Try to spread those chips on the table where you can, do it tax efficiently. And then time, not timing. For people that are building portfolios today that are worried that they've missed it, right? And am I going to be putting my 401k money to work today or something else, and the market's going to go down? That's okay. Take your time, go through the market. These are some slides that we use that are, I think, quick and easy to set that expectation with clients. But on this slide here, time in the market, not timing, right? And what the chart, or what the bars on the left show you, the columns in green, is the 1-year return of stocks over time. And you'll see where they've been down 37%, they've been up 52%. You feel great when you happen to be holding it and the stocks are up 52. You feel horrible when they're down 37. If you are accumulating, you're still investing, you're not retiring for the next 5, 7, 8 years, it's okay if they go down. Because invariably the economy grows up to now. The economy grows, corporate earnings grow, stocks grow, and you will see that reverse, and you'll see those stocks come up. So as you progress to the right, what you'll see is it's very, very rare to lose money in stocks if you have at least a 10-year horizon, right? So the risk of loss over 10 years from today, no matter where we're at, even if we are in a bubble, is quite low. The risk of loss, if you have to cash the money out in 2 years, it's quite a bit higher. So you have to think through that. I think the other thing that matters is when clients really think through about what are they trying to do, there is never an all clear. There is never, no one rings the bell at the top, no one rings the bell at the bottom, and no one can ever tell you everything is safe. The reason I got into investing was because the markets are different every day. New information is out every day. This year, information has changed as fast or faster than I've ever seen it. But what this chart shows you here is on the bottom in red, that's every year how much the market has gone down at some point during the year. And you will see in every year the market has actually gone down. On top, you'll see actually how much the market actually went up over the course of that year. And so it's quite common for the market to go back or to go down 10, 20, 30% in a year and then recover. Did anyone see Goldman Sachs was out and they're talking about a correction? We're due for a 10 to 20% correction in the next 12, 24 months. Sounds really scary when he says it. Well, why he's saying that is because history tells you, this chart tells you, you always have a 10 or 20% correction coming. You just never know when it's going to start, right? So don't read too much into that. But it does mean if you're investing and the market goes down 20%, you've got to really be prepared ahead of time to say, look, if I'm down 20%, I had $5 million. I'm now at $4 million. Am I okay staying at $4 million? Am I going to sell? If you're going to sell, it means you have too much risk in your portfolio. You have to make sure you can handle the downturn. So really quickly then, develop a plan, stick to it. Basic things, right? Make sure you know what you're trying to do, define your objectives, right? Think about your portfolio. If you've got the luxury, you've got new cash coming in, you've got liquidity events, you have an inheritance with step up in basis, you can think about starting from scratch. What's the portfolio I want to build? Go back to it, reassess it all the time, right? And to be clear, when I say all the time, don't look at your portfolio every day. I often tell people don't watch CNBC. CNBC is trying to sell fear. They're trying to sell greed. The market going up and down a quarter point a day is not exciting, so don't tune into that. But you should be thinking about your plan at least once a year, right? What can go wrong? recency bias, confirmation bias, follow the herd. And this is what I want to talk a little bit more about. People always get fixated on what's happening now. It just happened. It can happen again. It can happen more. So that's recency bias. Confirmation bias. Well, I think this might be true, and I just heard somebody else say that it's true, so it must be true, even if you just talk to one person out of 100, right? That's a horrible fallacy. And then the last is, back on the CNBC, follow the herd. Hey, I was at a party. They were talking about AI. It's going to be this. It's going to be that. I should really get my money out and do what everyone else is doing. Or back to Charles Kinderberger, I'm missing out. I have to get my money invested because everyone else is doing well. Set your own plan. Look at who you are as a client. Look with your clients. Figure out what they need and try to start from there. So with that, I do want to talk about the market. Just real quick on, are we in a bubble? Again, I'll tell you in a year. I think that, and it's really hard to say this, I think there's a lot of reasons to say that we're not in a bubble. This is always difficult to say. It's different this time, and often those are the most perilous words you can say. There are things that are different this time, right? There always are. That's why it's so hard to predict. This is a chart, and first and foremost, a plug for JP Morgan Guide to the Market. That's a publicly available resource. If anyone really likes stock charts or historical financial data charts, just Google JP Morgan Guide to the Markets, and you can pull up 75 of your favorite charts ever, and they keep them updated. This chart is really interesting to me because it shows the valuation of the S&P 500 over time. There was an article a couple days ago about Schiller, cyclically adjusted PE. I'm here after this. I'm happy to talk to anybody about that. I think it's a horrible metric, and I will literally get on a soapbox for 40 minutes and tell you all the things that I don't like about it. One of the things the article did really well is it talked about the fact that you have to look at the market since the mid-90s. That's right. Since the mid-90s, this is the valuation. And on the scale of this graph, we look really scary, but here's the most important thing. The black line represents the forward price earnings of the S&P 500. We are currently trading at about 23 times. That is historically relatively expensive. It doesn't mean that we're necessarily in a bubble. In 1999 to 2000, it did, but notice we first crossed over into that 22 times back in 1998. We were there for a very long time before the market corrected materially. Alan Greenspan famously said irrational exuberance in 1996. So the market not only went up to more than triple from there, it never came back as low as it was at the point when he said we're irrationally exuberant from a valuation perspective, right? Time, not timing. Be patient if you can. One of the reasons why the valuation, one of the reasons why the valuations are, he's going to kill me, this guy, the valuations are so misleading is because the companies that we see today are a much bigger part of the market than they were in the past. And so if we go and we take a look on the left-hand chart, this shows the PE of the top 10 in green companies in the S&P 500. Black is the S&P 500. Blue are the rest of the 490. In 1999 to 2000, those top 10 companies got up to valuations of 43, 44 times in aggregate. Today, they're high. They're 29 times, but they're nowhere near as high as they were. If you go to the right-hand chart, this shows you the weight of those top 10 companies, and it shows you what percentage of earnings they were. And this is something that I think a lot of people miss when you look at historical valuation. In 2000, the weight of the companies was 27% in the index, and they only generated about 15% of earnings. Today, they're 40%, and they're generating a third of the index earnings. And they are growing like nothing we've ever seen. And that's always going to be a question in a bubble, is that sustainable, right? But Rick Reeder from BlackRock was asked the question this morning, and his response was going through the company's earnings, looking at the free cash flow statements, all the free cash flow after CapEx, after share buybacks, after all the spending they're doing, is basically creating brand new companies in market cap every quarter, right? Microsoft's a $4 trillion company, and they're growing revenue at 18% and accelerating. And Microsoft, when you think about how they generate revenue, it's subscription. It's people buying that service. It's not, Microsoft isn't making money by selling huge data centers, right? They're making money by people buying out of their data center. So it's a very different model. So the biggest concern now is going to be, is this investment pace sustainable? This chart on the left is one that's been in the guide for the last 2 years, and it's great. What it shows in black is the level of spending inside of capital investment inside of hyperscalers, so the big companies that are participating in AI. So basically, these are the people buying from NVIDIA. In light gray is the expectation of future growth, and you'll see it is a hockey stick, and it eventually slows down. The most fascinating thing about this chart is what you don't see. What you don't see is the last 2 years worth of charts before this. These numbers have gone up every month for the last 2 years. Right now, CapEx for 2025 is showing at $400 billion. And if you look at actually the announcements from all the companies of last quarter, last week, it's probably going to be $500 billion, right? So the number keeps growing faster and faster and faster. And in that blue line in the chart, that is their cash flow. And what that tells you is they're paying for all of this out of their earnings and their profit. They're not borrowing, they're not levering, they're not doing anything that jeopardizes the financial health of their business. They're trying to invest to get ahead of a market opportunity. And the reason they're doing that is this chart on the left. This chart on the left shows productivity over long periods of time, and the economy is nowhere near the same as it was back in 1900 today, for some of the reasons here shown, right? So we can take a look at this low point of productivity is going to be World War I, and then you'll see at the top of that, you'll see in blue, it says electrification. And so basically what this is telling you is that in 1916 to about 1928, you actually had this massive investment of putting light bulbs, electricity inside houses, which meant that, by the way, people didn't have to stop work at 4 o'clock today because of daylight savings time. You could actually get them to work longer. And people did work longer. And productivity went way up. And productivity going up means that gross domestic product goes up. It means corporate earnings go up. It also happened to correspond to a bubble in 1929, people might have heard, right? You get a little excited, you start investing a lot of money, and so at the end of it, it was a bubble, but it took you 15 years to get there. And then you roll over, you've got the Great Depression, but then all of a sudden you've got automobiles, you've got infrastructure, you've got highways, right? So you see that moving forward. And the point of all of that is if you look at where we're at today, all the way on the right, productivity is very low. It's been very low because we have maximized most of the productivity enhancements of the internet. Now we've got this brand new computing technology, AI, that is creating productivity enhancements for most of the people that are wanting to use it. Jamie Dimon was out a couple weeks ago. They've spent, at JP Morgan, they've spent $2 billion on AI so far. They've already earned it back in the form of actually higher profits, right? You are seeing, and this is the concern longer term here, you are seeing AI being able to step in and do repetitive tasks, white-collar tasks, much more quickly and more efficiently with supervision than you're able to see people do it inherently. And so as a result of that, you're seeing hiring slow, you're seeing corporate profit margins explode, and the question is, when does it stop? Does it stop? That part we don't know. But as it relates to stocks going up, stocks go up when profits go up. They make more money, okay? I have the same PE 23 times, my earnings double, stocks double. And that's what's happening with corporate America today. On the right, you see that the businesses using AI are still actually very few. So there's an estimate of maybe 10% of businesses today are really trying to put AI in. So all of this spending that we've seen on that prior chart, all of this 18% growth in earnings from Microsoft, or revenue for Microsoft, and we've only had 10% of corporate America actually start adopting it. So if that really starts to accelerate, that's why people are excited about the valuations. Right? So back to risk or not to risk. For clients that have those large positions, again, it's really about diversification. Are they going to be comfortable if they look back and this was a bubble? Are they going to just be putting their financial future in jeopardy? If they have the risk tolerance to look at it and to stay there invested, you can make an argument with the large companies where this is time, not timing. Stick with it. One last thing on the bubble side. If this is a chart that shows consumer sentiment, we are all the way on the right here in green. You'll see where consumer sentiment is 53.6. There's two, I think, really interesting observations about this chart. When you take a look at when consumer sentiment is low, what the numbers in blue show you is what is the next 12-month return. And so in June 2022, the market sold off, consumer sentiment really went down quickly. The next 12-month return from that was 17% because the market had sold off, and so at that point in time, it was kind of upside. Same in 2008, right? Sentiment bottomed. The next 12 months return was 22.2. And the big point there is that you can't find low consumer sentiment here where you have poor next 12 months returns. Doesn't mean this isn't the first time, but it's very, very rare. On the flip side of that, if you look at the top of the chart, when consumer sentiment is high, you'll see where that forward returns were actually quite low. And in particular, I'm also going to point out, if I look at right in the middle of the chart, January of 2000, yeah, sentiment was really high. People felt great. The market, by the way, was very close to a peak, right? 2007, people felt good. The market was very close to a peak. And so it's very atypical, doesn't mean that it can't happen, but it would be very atypical for this market to be a peak when everyone feels so bad about it. Okay. All right, so with that, I'm going to zip through real quick just because one of the themes today is crypto. And we talked about complexity. I think Rustin's, I think when I listened to Rustin's presentation, what I was thinking was, this probably makes a lot of sense for a lot of people that have already made $5, $8, $10 million. They've had their cryptocurrency explode. When I think about cryptocurrency, Rustin talked about cryptographic, that's the blockchain part, huge technology, opportunity. What it means down the road, don't know. When I think about currency, I can think about stable currency or fluctuating currency. The stable currency are the ones that are pegged to the US dollar. I haven't had a single investor come up to me and say, hey, I want to buy a stable currency because that's the way to get rich. Because you would say, well, no, it's just going to be a dollar, right? So where I see most investors get excited are ones that haven't made the money in it yet, that are worried about investing in currency debasement. They're worried is the dollar getting weak. And so then they'll start thinking about doing Bitcoin or something like that. All right, for those clients, they don't already have a lot of the technical complexities that Rustin was talking about. And a very common argument might be that money supply is growing, right? Money is devaluing. I mean, I started off by talking about lotteries at almost $1 billion, right? Just really ridiculous numbers. This chart shows in blue, M2, that's cash available basically on the sidelines. That's a measure of money supply, and that has been growing. And on the left, we show Bitcoin. And you can look at this and say, look, money supply is growing, Bitcoin's growing right in line with it. Now, anytime anybody looks at a graph, I always caution them, read the fine print, really look at it. What is it saying, right? On the left, Bitcoin, even though they're moving in tandem, Bitcoin went from $1 to $4.50 on the left-hand axis. Money supply went from $1 to $1.06, right? So I went up 350% or 6%. Are they really the same thing? I'm not convinced they are, but it's an argument that people have, and they've gone up. The other thing I would say just about cryptocurrencies from an investment perspective is if you want to make the investment because you really believe in it, right? Or you're willing to take that risk, right? Fear of missing out, or it's because your son's calling you at 3 a.m., fine. But recognize that there's a lot of risk, right? So Bitcoin sold off 84% back in 2018. It sold off 77% back in 2022, right? So you have to walk into it knowing that this is money that you're putting at risk, maybe a permanent loss, maybe not. And so then we start thinking about, if a client came to me and said, I really want to do this, and I would talk about, okay, how do we do this, right? What can we do today? And does it make sense to buy the crypto directly and actually have to deal with all of the technical complexities we just talked about? In today's world, it doesn't have to. If you're really focusing on that currency and the fact that you're looking for that currency to move up, well, Bitcoin has ETFs that trade around it that hold Bitcoin as your underlying commodity. So they're very directly tied. Ethereum has the same. They have options markets on them. Anytime you have options market on something that as a public security, it means that is going to be capital gains treatment, and you can control your payout diagram. And so without going through all of the nuances here, but happy to, you can create, and I've actually done this for clients, where you can create a synthetic structure tied to Bitcoin that will give you one-for-one unlimited upside. So if anyone's familiar with a structured note, this is basically like a structured note. But you can create one-for-one upside with Bitcoin, and I can actually engineer it so you have a 37.5% maximum downside loss, right? So if you're thinking about doing Bitcoin directly, taking on the complexity, the private key, random fact many of you might know, more than 20% of the wealth of Bitcoin is estimated to be lost permanently, irretrievably, because people have lost those private keys. They had it on a hard drive. They threw out the hard drive. It's sitting in a dump somewhere, right? You've seen cases where people have actually tried to go excavate the dump because they think there's a $100 million hard drive in there. It's easier to do it out of your investment account. That's where I finished with that. And I think with that, I'll give it back to you. Lou?
Take questions, Sean.
Any questions on? Yeah.
I think I've noticed that you can buy Bitcoin independently, and/or you can buy the ratios of like Bitcoin to the U.S. dollar or Bitcoin to, the euro.
Yeah.
And I'm wondering what your opinion might be on buying either of those products and which might work better than the other.
Yeah, so they'll be quoted both ways, like currencies. So before, is a commodity, is a currency. Whenever I go to get a quote, I'll see Bitcoin quoted in both ways. I'll see the US dollar quoted against euros, right? But what you're going to do ultimately is buy the one asset. And when you buy the asset, it's intrinsically valued in US dollars. So if you're buying it in US dollars, if your argument is debasement, so it goes back to why do you want to buy it? If the argument is debasement of the US dollar currency, then I would say that the currency is going to debase likely in that case against maybe Bitcoin, against gold, also probably against other currencies. It's not my view, but if that's the argument, then I would say you actually want to buy Bitcoin in US dollars because that's where you're going to get the most leverage. And so in that case, then again, I would just go back to, do you want to go through the technical complexity of buying the cryptocurrency if you don't already have it, or do you want to actually do it through an investment account where keeping track of it and paying taxes on it is a lot easier? Yeah.
Other questions?
Sure.
So say I'm one of your older clients.
Elder client, yeah.
75 years old.
Yep.
John, the neighbor, told her about Bitcoin and Ripple and all these other good stuff.
Yeah.
And now she wants to invest. Give me Bitcoin at a pill form.
Give you, when you say give you Bitcoin as a pill form.
In a pill form, meaning not as
Yeah.
complex as how you would talk to us today.
Yeah.
But you would talk to a client, and that being elderly, 75 years old. She talked to a neighbor. Neighbor
Yeah.
said, you should do this because it's the best thing in the world.
Okay, so for if people couldn't hear it, basically it's if I have an elderly client, and I would say, look, it doesn't have to be elderly, but I appreciate the context. Try to simplify what Bitcoin is if they're getting told it's a good investment, right? And so first and foremost, when I think about what Bitcoin is, for most people, it's just an alternate currency. It's instead of having money in the mattress, instead of having money in your checking account, and instead of buying and having maybe European-based currency that you picked up while you were traveling, Bitcoin is a way for people to think they can diversify against the US dollar. And then my very next statement to them would be, but here's the difference. The difference is if your money is in the bank account, we know how much that is. And by the way, we've got FDIC insurance, and we can rest confidently that that money is there for you. Bitcoin has no stability around it like that. So if you buy Bitcoin because you think that it might go up in value, I just want to let you know it might go down 80%. And are you prepared if you wanted to put $10,000 into it, that in 6 weeks from now, it might be $2,000? And how do you feel about that? And I'm gonna guess it probably is a 75-year-old that's wondering about Bitcoin. They're gonna say, I don't really want that level of risk. Yeah, is that helpful? Yeah, okay.
How many people own cryptocurrency? Just by show of hands. Still a relative minority.
Yeah. No, right behind you.
For
Sorry.
someone who's young in their career and starting to really focus on investing now, I know you mentioned saying like you don't want to look at your portfolio like every day. And maybe,
You must be making a good buck there, young man.
and like you want to reevaluate maybe like once a year and whatnot.
Yeah.
What would you say to someone who's young and possibly looking into investing into crypto, AI, stocks? But what would the reevaluation look like for those since they could be more volatile?
Yeah. So I'll repeat it. So, the question is going to be, so for somebody who's hoping that they get a bonus this year, right? If they were to get that bonus and be able to invest, what would it look like and how often should they check on that? So look, as a young investor, right, general rule of thumb, you have that time. And if you go back to that chart that I looked at, if you take a 20-year horizon, and every young person here is hopefully working for more than 20 years, hopefully through love, and right, not because I have to, but you have plenty of time for the market to go down and to come back. And most importantly, as a young person adding to a retirement plan, if the market goes down, you're putting new money into the market and you're buying at lower levels, so that is a great place to be. So really the question then is not about reassessing it. That's going to stay relatively constant for you for the next 15, 20 years. Again, 10 years, it's very difficult to see losing money. So most people start reevaluating 10 years before retirement. Until then, you're in growth mode, you're in accumulation mode. There, it's a question of relative risk and how confident you want to be. Look, the nice thing about stocks is corporate earnings. Companies make money. And I mentioned the valuation on the stock market. It's tied to how much money companies make. Over time, companies grow, earnings grow. So over time, that's why stocks go up. Valuations will move around. The challenge with crypto from an investment perspective is that there's no earnings, right? So you don't have any fundamental value to tie it to. It's got to be a real belief that there is a problem with the money supply and this is going to be the most efficient way to fix it. If you have that belief, having some part of your investment portfolio tied to it can make sense. Just be prepared for ups and downs. Yeah. And on the AI side, AI is already encapsulated in corporate America, so you're getting that. I mean, the top 40% companies, that's the Magnificent Seven. They all are major beneficiaries of AI. So you already have that. Yeah.
How many own NVIDIA? Good for you.
Yeah. Well, wait. How many have an investment in the S&P 500 through a retirement account or any other type of investment account? Okay, you all own NVIDIA, right? So just to be, you do. You all own NVIDIA, you own Microsoft, you own Amazon, right? In a pretty large amount. Yeah. Okay.
Thank you, Sean. Nice round of applause.
Thank you.
Sean Leonard.